good morning all. Nearly a full house, fantastic. Thank you for joining us today and welcome to the Maidan Free Zone Corporate Tax Seminar. I am Adnan Raja, CFO of Clyde Co Middle East and Africa, and I also have the pleasure of being the moderator for the event today. Free zones are an integral part of the UAE economy, driving growth, transformation, and innovation, not just locally, but also internationally. They offer businesses opportunities and benefits that are not available to mainland entities, such as relaxed foreign income, ownership across all sectors, streamlined administrative processes, modern and sophisticated infrastructure, developed business communities, emirate-level tax holidays, and importantly, different legal forms and commercial activities. All of these benefits are available to entities such as yourselves in the Maidan Free Zone. The Free Zone corporate tax regime allows businesses to benefit from a 0% tax rate on income derived from qualifying activities and transactions. Now, it's important to understand that this applies to income generated on transactions and activities from and within the free zone. To explain this in more detail, we have an expert panel of presenters today. I'm joined by Tim Dopheimer, Tax Director at Ernst & Young, Reggie Mezu, Head of Tax, Middle East and North Africa for Baker McKenzie, and also Thomas Vanny, Partner at Aurifer Tax Consultancy. Just some housekeeping. The presentations will follow, and after the presentation, we will have a short break. Following the break, we will have a question and answer session where I will be joined by the presenters. Can we please keep all the questions to that session right at the end? We will have a full hour, so you'll get plenty of opportunity to ask your questions. If you want to write your question and pass them over to me, I will be happy to read them out as well. After the Q&A session, there will be lunch in the same area outside that you've just been to, so please join us there as well. Right. Before I hand over to our first presenter, can I please ask, by show of hands, how many people here have worked in a tax environment or a tax jurisdiction before? Not as many as I thought there would be, but quite interesting nonetheless. I think regardless of where you've worked and which country that was, taxes are still very unique in each jurisdiction, and they come with their own challenges. And of course, to explain that uniqueness to you, without further ado, I would like to invite Reggie Mezu to start off talking about the legal aspects of the UAE corporate tax. Thank you.
Good morning. Welcome, everyone. So what I essentially want to do for the next 15 minutes is just run through the legal aspects of the tax regime that you guys suddenly have on your hands. Now, tax is not one of those things that the government would kind of willy-nilly impose on people. It's got to be based on the law, and it's almost because it has to be based on the law. It's a contract between the government and the people and the businesses. So everything has to be very clearly defined, and not surprisingly, it's taking quite a long time for the various laws and regulations to come into place, particularly the parts that have to do with free zones. But let me just go through very quickly. How do I? So what I want to do in the next 15 minutes is just go through the legal framework and the timelines. We'll then talk a little bit about taxable persons. But I think what's more relevant to you is how the free zones will be taxed. So we'll just run through that really, really quickly. there's a lot in it, but Thomas and Tim would go into a little bit more detail on what those mean. And then we'll talk a bit about the practical application points, the stuff that might be relevant to you. And if I have enough time, I'll just introduce you to some of our core team of the Baker McKenzie tax fraternity in the Dubai office. So the tax law itself, you'd find in decree number 47. It's essentially described as the taxation of corporations and businesses. There's a subtle distinction there. But that's not all. The tax law sets out the content of what the tax law contains, but you also have, quite importantly, and I'm sure a lot of you have had to face VAT issues or VAT compliance things, you have the tax procedures law and the regulations that go with that. Supplementing the tax law are cabinet decisions, which within a more conventional legal sense you'd call bylaws, which are the laws that are there to clarify the details of what's in the tax law. So you'd find the cabinet decisions will probably, there must be about 40 to 50 cabinet decisions. About 20 or 25 have been published so far, but the full content of the cabinet decisions is going to be much heavier, possibly, than the tax law. Supporting that, you'd also have the ministerial decisions, which would effectively be decisions that are coming out of the Minister of Finance himself, rather than the cabinet. And then you'd have decisions coming from the authority, the tax authority. You'd ask yourself, why should the tax authority be making laws? Is the tax authority is also a party to any disputes with you? No, that's actually controlled. So the tax authority would only be able to make decisions if they are doing so in exercise of powers that are delegated to them by the minister. And then you'd have administrative policies, processes, and procedures as well, if those are delegated. So one of the subtle things is you'd find the tax authority issuing guidelines. Those guidelines are not actually part of the body of the law. They're just the tax authority's interpretation of what the law would entail. It's important to have that in mind, because when you then go for disputes with the courts, the guidelines have less of a consequence, and the judges or the tribunals who are adjudicating are essentially looking at the law, right? But beyond all of that, you also have the double tax treaties. So the UAE has signed up to probably as much as 90 double tax treaties with various countries. Those are conventions or agreements between them as countries. They form part of the law. But it's important to know about the double tax treaties as well, because they override the domestic law when there are disputes, right? And so for you, if you were, for example, if you've got, say, a Singapore company as your parent with a subsidiary in the UAE, you're not only looking at the UAE tax law, you are looking also at the double tax treaty between Singapore and the UAE, because the content of that law would override provisions of the UAE law which are not consistent with that tax law. So I mentioned the guidelines, the clarifications, and the court's decisions would also be a helpful framework for the law. So I suppose what you want to get out of this is it's not just the decree number 47 that is the law. There's a whole body of laws and decisions that you'd have to take account of when you're thinking about the law. So in terms of timelines, I think the most important thing you'd want to check for yourselves is what's your registration, what's your effective date. So the law came into force 1st of June this year, but for your specific enterprises or companies, it doesn't come into effect until your first accounting period. So for those of you who have 1st of July as accounting periods, the law is going to come into effect within the next 10 days. For many of you, I believe, who have calendar years, the law doesn't come into effect for you until the 1st of January. But however, before that, there are a lot of anti-avoidance things that you have to be conscious of if you want to be preparing yourselves for the implementation of the law. In terms of actions, the next important date for you would be the registration. So it's not clear, I mean, I'm not so sure whether the registration portal has been open to everyone, but for a start, there's a level of discretion as to when you actually start to register. But if you can, it'd be important if you do register as soon as possible. The most important thing to realize is you have to file your tax returns, and you have to file those tax returns within 9 months following the end of your year. So if most of you who have calendar years, your first returns would need to be filed in September 2025, which is 9 months after 31 December 2024. Taxable persons. We'll run through that very quickly because we don't have. So there are broadly two ranges when you talk about taxable persons. There's the resident person, and the resident person is essentially a company that is incorporated in the UAE. So if you guys are incorporated as corporate entities in the Maidan zone, you are a resident person. Also, if you are not incorporated here, but you are controlled and managed in the UAE, then you are a resident person as a company. But if you're not a company, but you are a natural person, which is effectively an individual, and you do conduct business actively in the UAE, then the tax law, although it's called the corporate tax law, it could also apply to you, even though you're not a corporate. So what's a non-resident person? A non-resident person will be someone who is a company that is not a resident person, but has a permanent establishment in the UAE. In more conventional speak, that means a branch of a foreign company. So a branch of a foreign company is a non-resident person, but it is taxable because it has a branch in the UAE. You may not have a branch in the UAE, but if you derive state source income, i.e. UAE source income, which needs to be further defined, then you could be a non-resident person that is subject to tax, right? And the other one is if you have a nexus in the state. So there will hopefully be a cabinet decision soon that would explain what the nexus would constitute. You could also have individuals, as I mentioned. That's a natural person that conducts business. You could have unincorporated partnerships and foundations. For unincorporated partnerships, you're not a taxable person. The partners will be taxable persons. For foundations, you are a taxable person, but you can elect not to be a taxable person so that the members of the foundation become taxable. And there are lots of exemptions as well, but I wouldn't go into those. Just the rates. If you're a taxable person, you're subject to tax at 9%. And that taxable person, as I mentioned, could be both resident and non-resident. If you're a qualifying free zone person, you'll be subject to tax at 0%. There's also a small companies relief. So if your income is your revenues is about 3 million, you can make an election to have a small companies relief. I should have also said that if you're a taxable person, you're only subject to tax at 9% if your profits or taxable profits exceed 375,000 dirhams. What the law hasn't really said, but it's expected that there's a potential 15% tax regime for multinational groups whose income exceeds a certain threshold, about 750 million euros. Now, I'll run quickly through free zones because I think that's what's most important for a struggle with this. Right, so the Maidan free zone Article 17 of the Maiden Free Zone Law does specify that an entity that has operations in the free zones is effectively exempt from all taxes, including income tax, for 50 years. And that the period will start from the date on which you are established in the free zone. Now, the Maiden Free Zone Law, as with many other free zone laws, are really municipal laws, like Dubai laws. And so the tax law in itself is a federal law. And so to a large extent, you could say this does not hold the federal tax authorities from imposing a law. And that's what has happened. But in order to kind of bridge that and come to a kind of happy compromise, free zone persons are not subject to tax provided they meet certain conditions. Tim and Thomas are going to go into a few more details about how that works. However, if you do meet those conditions, then the entity is not subject to tax for the period that is covered by the law. So for 50 years, if you meet the qualifying conditions, you would not be subject to tax. And what the main conditions are, firstly, that you must have adequate substance in the state. Secondly, that you must derive qualifying income, which Tim and Thomas would explain to you. And you've not elected to be subject to tax. So you could be a qualifying free zone person, but you might, for some other reasons, prefer to be subject to tax. That will be explained as well. The other critical thing, too, is if you want to enjoy the benefits of being a qualifying free zone person, then you must maintain transfer pricing documentation. And then you might meet other conditions which might be specified further on. So the key things to bear in mind are you must have qualifying income. Qualifying income is heavily dependent on who you're providing the service to. So if you're providing the service to another free zone person, then you're okay. You don't have to start thinking about whether you have qualifying activities. If you're providing the service to a non-free zone person, then you need to have qualifying activities, provided you're not undertaking excluded activities in both cases. If you are not providing qualifying activities, then, but you're providing other types of services, you run into this de minimis rule, slightly complicated, where if a lot of your activities, if your activities exceed 5 million, if your non-qualifying activities exceed 5 million, or 5% of your total revenues, then you are not a qualifying free zone person. So when you work it out, I would imagine that many of you here would actually be subject to income tax at 9%, unfortunately. You can always elect to be taxable. And what all of that means is, if you're subject to the income tax, some of the difficulties or compliance aspects that you would have had to meet if you're a qualifying free zone person would not apply. One of them is to maintain transfer pricing documentation. Another is to have audited accounts. So what some of those practical points? Yeah, when I said many of you will probably be having to pay tax, if your service companies are providing services to persons who are not free zone persons, which many of you would be doing, and non-free zone persons include foreign companies or foreign customers. So if you're providing services, for example, to companies all around the world or customers all around the world, then in all likelihood you would not qualify to be you would not be a qualifying free zone person, and you'd be subject to tax at 9%. If you're an inactive company, which means you're dormant, you've got your bank accounts, you've set up, and mainly you've set up the company initially to get your visas. Unfortunately, you would have to file accounts, you'll have to file tax returns, right? You may not need to have audited accounts if you don't have, if you're not expecting to be subject to tax at 0%, but you still need to have, to file your returns and on time. So that represents a sort of compliance obligation. If you're active companies, of course, then you have to go through the whole process of trying to identify whether you're subject to tax, not so much subject to tax, whether you're a qualifying free zone person or you're not, and what your tax rate would be. If you've got branches on the mainland, that puts on a different spectre as well, because what you'll be regarded as a free zone person that has a permanent establishment in the UAE or in the mainland. And then the rules are different because you'll be subject to tax on all of your activities in the mainland. As I mentioned, you need to have audited accounts. One thing you've got to consider is what's the interface with VAT. That's important as well because when you get audited, the tax authority would want to ensure that your whole revenues and all those lines tie in, right? So there must be many, but I thought in the context of how you operate and what the practice would be, those are the sort of things you'd want to be careful about. I think I'd leave. I've just been reminded that I've exhausted my time. And I think when we have the panel discussion, I'll be more than happy to talk about anything that you'd want. But thank you very much.
Thank you, Reggie. That was a very concise and clear presentation. I hope you found that useful. I mean, from my perspective, I understood today that it's not just the tax law that we need to read and understand, it's the ministerial decision, the cabinet decision. So lots of bedtime reading for everyone here, I believe, which is going to be interesting and exciting, I'm sure, over the next months, weeks, days. So to talk more about how this impacts our free zone and the application of the corporate tax to free zone entities like yourselves, I would now like to invite Tim to take the stage, please.
Hello everyone, good morning. My name is Tim Dotmeijer. I'm a director in Ernst & Young, EY. I'm almost 10 years in the country. Before I kick off, I would like to say that, I mean, the law is new to everyone. It was released only on the 9th of December last year. Ministerial decisions came in mostly in June, so it's still a relatively new topic for all of us. I think that we have a reasonably good idea about what's in it, but there's also, as pointed out by Reggie, a couple of unknowns. We work through it, but at some points there's no final answers yet, but we try to be as specific as possible. Yeah, one step back. Why, in the first place, do we have corporate tax, and why now? There are a couple of policy reasons. These are outlined by the Ministry of Finance in the most cases. Reggie already touched upon the global minimum tax of 15%. That is, we believe, a policy driver why the UAE is coming up with the tax law at this point in time. What we believe is that the Ministry of Finance and the federal tax authorities want to be business friendly. They're open to dialogue. So we are happy to be in this environment for the good reasons. Some aspects of the corporate tax law. These are the topics during my presentation, so I don't touch upon them right now. What is taxable, what is not taxable? Reggie already touched upon some of this. It is very important, what I see in practice, is that if you have any companies outside of the UAE in your group structures, so outside of your free zone entity or branch in the free zone, which you actively control in the UAE, that entity will be subject to tax. I see that a lot of times with my clients that this is overlooked, but that will be a UAE corporate tax, so please pay attention there. Other than that, it has pretty much been covered. So I move on. The exemptions. So the law has a number of exemptions. On the right side, there are besides the exemption for qualifying free zone persons. There's also the subject level exemptions, which is, for example, for government entities, government controlled entities, extractive, non-extractive businesses. And also there is one for entities which are owned by an exempt entity, which is not on the slide. There's also a small business exemption. Reggie already touched upon this. It's good to note that this one applies only until 2026, and if you ever have a revenue over 3 million, then you discontinue to benefit from this exemption, even if after the period of time your revenue drops below the 3 million threshold again. I think that sums it up for this one. Yeah. All right, this is the interesting part. It looks a bit overwhelming, I agree. But this illustrates that, okay, this is for about free zone persons. And the distinction between which type of activities can be taxed against a 0% rate or against the 9% rate. What we have tried to do is we have tried to make a flowchart which gives us the answer, but this flowchart needs to be applied for each and every individual income stream. So that is a lot of work, potentially. We have a list, and I'll go back to this slide in a second. We have the list of the qualifying activities, and we have a list of the excluded activities. I try to go back. Oh, yeah. If your counterpart of your transaction from which you derive your income is a free zone person, you get the 0% rate, provided that the activity is not an excluded activity. If your income is derived from a non-free zone person, then it needs to be income which is on the qualifying activities list and not on the excluded activities list. There's one more condition which applies in both cases, and that is the de minimis threshold. That is the test, the ratio test that Reggie pointed out, which says that the lower of 5 million or 5% of your income cannot be cannot be non-qualifying income. If that is the case, then all of your income is tainted and taxed with against the rate of 9%. So that is, in short, what, let me see if it works, what this flowchart tries to say. Yeah. So, and this is the list. I don't want to go through all the details. Perhaps I want to point out one item, and that is that income from immovable property is on the excluded activities list, except to the extent it is income from commercial immovable property situated within a free zone. So that income is potentially subject to 0%, but other income is from free zones is taxable against 9% based on these rules. All right. I think that Reggie touched upon these different types of income, so I don't want to repeat myself too much. All right. Transfer pricing requirements, that is, I think, a good one to spend a bit of time on. Transfer pricing essentially means dealing on terms and conditions between related party companies in a way which reflects market conditions. So if you have entities within the group, within your corporate structures, which have business transactions with each other, and for example, you lease a building from one company to another company, and you don't charge for that, that is then probably not in line with transfer pricing rules and regulations, because transfer pricing says, would you do the same thing to a third party? If so, then you need to follow the same terms and conditions. Why is this important? That is because the corporate tax law prescribes in which situations you will be required to follow transfer pricing rules and regulations. And when you need to do that, but you don't do it, the tax authorities, they have far-stretching powers to correct your business transactions as if you would have followed this. So they can make adjustments on both sides of the transaction. So it is not, your commercial accounts is a starting point, but on top of that you have to consider, are all my dealings with related parties, and the definition of that is in the law. Is it at arm's length? Do I need to comply with these transfer pricing rules? And if so, do I want to make changes to how I deal with my group companies? Because otherwise, tax authorities could impose those changes upon you, and then you might get to outcomes that you don't expect. All right. This is a road. I know that Thomas also has a road slide later on in his presentation. It is the journey towards the introduction of corporate tax. Yesterday evening, I saw that the Ministry of Finance put out a message that the portal is open for certain types of taxpayers, including public joint stock companies and I believe single shareholding companies. So registration should be possible. What I do think is don't rush immediately to the portal and register. Try to determine your tax position first. There are also rules around tax grouping. So that means that if you own a number of entities, you could form a tax group similar to a VAT group, but with different rules and requirements. There's a 95% ownership requirement so that you can register a bunch of entities as a single taxpayer for tax purposes. You have a tax group. Within that tax group, transfer pricing doesn't apply. All the transactions within the entities within the group are consolidated for tax purposes. So that could give you an ease of admin and compliance. But before you go into the portal, determine your position. Do you want to use these rules? Don't you want to use these rules? Do you want to elect? So, because if you make a registration, then potentially it might be more burdensome to amend an existing registration than to do it correct from the first outset, the way you intend to do it. And there is sufficient time. So in my view, I advise my clients, don't rush yet. There is a bit of time. Determine your tax position, consult with your advisor, make an impact assessment, see how the rules apply to you. Is this, and if you are certain how you want to do it, how you want to deal with it, go into the portal and register. But keep in mind the timelines. It's on the slide. Yeah, this slide is about the compliance requirements. This has already been explained by Reggie. It applies the law from financial year starting on or after 1 June 2023, with the first tax return being due 9 months after the end of the financial year. And that's on this slide. You can make an application to the federal tax authorities to amend your financial year for good reasons. For example, if you want to align the financial year of different group entities because you want to go into a tax group, that's a valid reason. I was not allocated a whole lot of time, but I'm available as part of the panel later on and also beyond that to discuss any questions that you may have. Thank you very much.
Thank you, Tim. I probably need a whole day to understand that boxy diagram, the flow chart, but that's just me. I'm sure everyone here understood that quite well. But I think in summary, tax is complicated, right? Does everyone agree? Right? No? No? Someone doesn't? That's your man. If you're a tax advisor, I think we should all come to you. But we need help, we need support, and I'm sure we'll be reaching out to our valued tax advisors, including myself. I will be reaching out to them to get some more better understanding of what it means, how it applies, etc. I'm just curious, can I just ask again by show of hands, how many people here will actually be responsible for administering tax for their businesses or their entities? Interesting. The others are here for just general tax understanding, I guess. But welcome, welcome to everyone. It's interesting group of people because not many people have actually worked in tax, and there are a fair few new people who will be dealing with tax for the first time. So what does that mean? How do we actually administer tax? To present that, I invite Thomas to take you through the tax admin process. Thanks.
All right, good morning, everybody. Hope you're doing well. My name is Thomas. Thank you for the introduction. Thank you to Maidan Friesen as well for organizing this event. We need these events. We need a lot of them, and maybe we're going to need them on an annual basis as the law might evolve and change. And as Tim has said, there's different interpretations sometimes, and that might actually sometimes throw us off, and we might have to reconsider what our position is. So it's good to be with yourselves. I have been granted a bit more time to look at some of the practical aspects. As Tim said, I also have a road. Tim's road was going left and right. Mine is winding, but in the end it goes straight to the target and to the end point. And the end point is the tax return that all of yourselves are going to be filing 9 months after the end of the financial year. Yeah, some of you are going to say, well, now we can switch off for the next half an hour because it's only going to be by September 2025 for those of you who are on a calendar year. But I would suggest that nonetheless you start already bit by bit preparing for that filing. And how to prepare for that filing is a bit of an illustration on this slide as well. And Tim's famous boxes. I also have a couple of other boxes to show you, and you can see which drawing you like the most. But we'll start off with the road, with the winding road. Essentially, the CIT impact assessment. It's a bit of a woolly word. It's essentially, you reporting towards your management what the impact is going to be. That impact might be relatively straightforward for if you're a small company, if your operations are relatively easy, or it could go up to a very complex level, like for some clients of ours whom we've been assisting since January already to try and understand how it will apply. Review structuring alternatives. I would say with a blink of an eye, that doesn't mean move out of Maidan Free Zone. If anything, you should remain there. A little wink to our sponsors today. A transfer pricing study, I think Tim referred to it before. If you're dealing intra-group, then dealing intra-group needs to be done in the exact same way as if you're dealing with someone outside of the group. And that might be very important if you have a number of functions centralized in the UAE, which are providing services, for example, to other entities abroad. Systems impact. Again, here that might go from the easy to the very complex. The easy one would be, I have a chart of accounts. Can that chart of accounts, can my P&L, can my balance sheet capture all necessary information for the purposes of the CIT return? Again, that might go from the easy, can I identify entertainment expenses which are not deductible, towards Tim's famous boxes, my famous boxes, where essentially you will have to try and identify what your income streams are, which can benefit from 9%, from 0%, because also expenses which are, for the purposes of the 0%, are not going to be deductible. So you're going to have an allocation there. So that might be something to think about. Financial impact and simulation. Yeah, VAT. I was speaking to someone a couple of weeks ago. They said VAT is a nursery tax. My heart was bleeding a bit. But what they meant is it doesn't have a bottom line impact, and corporate income tax does. And now that bottom line impact is softened due to a couple of provisions in the law. Number one is if you're a qualifying free zone person and you can claim 0%, hurrah, I just have the compliance aspects. But it could go beyond that. You actually could have 9%, but you have that first 375,000, which is not subject to any taxes on profits. In addition to that, the small business relief that Tim was referring to, which is applicable until 2026 for revenues up to 3 million dirhams. So that's a bit of a soft landing to get into it, and that also means that your financial impact, your bottom line impact, might be slightly less than what you would expect. And then the end goal is obviously to file your tax return finish line. However, we're going to have to do this every single year. And even though you're a free zone company, even though you might benefit from 0% taxes on your profits, you will have to file that return anyways. So that is going to be an ongoing exercise in addition to all of the other compliance obligations that you have. So step one is essentially, does corporate income tax apply to me, and to what extent does it apply to me? We're going to go through those lists of qualifying activities, excluded activities. Bear with me. It is not easy indeed. We would have hoped that the suggestion from last year's public consultation document published by the Ministry of Finance that all income with third countries would have been simply subject to 0% on profits. That is unfortunately not the case. It is a fairly complex regime, and mistakes will be made. Need to assess a couple of the requirements. The date of the CIT application was referred to before already. If your your financial year starts on the 1st of Jan, then it's only on the 1st of Jan that corporate income tax will start applying. Your accounting period or your tax period, your financial year equals your tax period. So 9 months after that is the filing of your first corporate income tax return. Your deadline, that 9 months, filing and payment at the same time, 9 months after the end of the financial year. Any potential elections to be made. So why on earth would I want to pay more taxes? Well, there's a couple of advantages there by actually opting in. One is that it's likely that an entity which opts in can be part of a tax group, which could have a couple of benefits. And the other one is when you look at international transactions between the UAE and other countries, sometimes other countries, they look at the UAE as a tax haven due to the rate being relatively low. Now, if you opt in from 0 to 9, you may be able to not have that measure being applied. One of those measures is something called the Controlled Foreign Corporation Rule. I can elaborate on that maybe a bit more during the Q&A. Financial statements, you will have seen that we need audited financial statements. Those are compulsory, and those financial records will also serve as the basis for the filing of the CIT return. So in terms of compliance governance, it's only getting a bit more strict and more requirements being introduced. Qualifying income. It was really for the longest time a bit the question, and I'll maybe also caveat for yourselves is this is just something that I noticed because our slides have been converted. The font is slightly different. You'll see the right font when you get them in your mailbox. The legislation I won't discuss much because both Reggie and Tim have discussed what the law is, or what the cabinet decision and ministerial decision is that we're basing ourselves on. Indeed, the clicker isn't always helping. So you'll see on the flow chart, my boxes, that we're distinguishing a couple of types of income streams. Yeah, when you start off, one back, not there yet. This one, yeah. I don't know. Someone is trolling me, maybe. So we need to distinguish income which is earned from another free zone person and was earned from a non-free zone person. That's essentially the first question that we need to ask ourselves. And when it comes to other free zone persons, it's other entities which are established in a free zone that have a license in the free zone, any free zone for that matter. A non-free zone person is someone who's not a free zone person, is what the law says. So by interpretation, that means mainland entities and third countries as well. Those are non-free zone persons. When it comes to non-free zone persons, we only need to look at excluded activities. Yeah? If you fall into the bucket of the excluded activities, that type of income is 9%. When it comes to income which is earned from other free zone persons, we have, according to the law, 2 buckets, but it's hard for me to reconcile them. So for me, there's a third bucket because we have qualifying income, excluded activities, and something in the middle, which I would term as non-qualifying activities. Hopefully the graph is a bit clear. A couple of concepts as well, which, and I need to pull up my phone as well to make sure that I don't bore you for too long. A couple of concepts as well are important. One is a concept of a beneficial recipient. So you cannot deal with another free zone entity and that other free zone entity essentially just having to pass on what they receive from you to another person just for the purposes of enjoying the 0% on the profits realized from those activities. So this is a bit of an anti-avoidance rule, if you will. We need to make sure that whoever you're dealing with is actually the recipient of the services or the goods that you're supplying. I'll spare you the definitions of the what is goods and services. This is my not my opus magnum. It's probably the opus magnum of some of my colleagues. Essentially, what we need to do is we need to identify buckets and sub-buckets. Yeah. This is essentially like my daughter playing in the sand. She needs a big bucket and a smaller bucket. The big buckets are 5 types. Yeah, and we can start on the right-hand side with a foreign PE. Yeah. If you don't have a foreign PE, just forget about it. A foreign PE could be a foreign branch, which would be a formalized way of having a PE, or it could just be a factual presence in another country. Yeah, that factual presence, we can either claim an exemption for it or a credit, the exemption being subject to the fact that that foreign PE is at least subject to 9%. If you don't have that, then throw away the bucket, throw it out of the sand. The other one is the domestic permanent establishment. See, this is a tough concept. It's a tough concept for us because it's not a very common thing. The domestic permanent establishment is essentially you are in a free zone, but actually you have offices in the mainland, you have people working for you in the mainland, or you have someone in the mainland who's highly dependent on you for their business. That would make that you have a domestic permanent establishment, and you need to allocate profits to that, and that domestic permanent establishment is simply subject to 9%. If you have a dual license, for example, free zone and mainland, that would very likely put you in the bucket of having a domestic permanent establishment. We're working our way up a bit in terms of complexity. Immovable property, I'll maybe bring the 2 buckets together. Tim already alluded to it. Essentially, what you need to understand for immovable property is it's 9%, except if it's commercial property inside the free zone, rented or sold to another free zone person. Everything else is 9%. Yeah. That's for immovable property of a qualifying free zone person. And then we get to the big bang, the free zone versus non-free zone person. Yeah. With a free zone person, as I mentioned, we need to look at excluded activities. If your income is from an excluded activity, it's subject to 9%. If it's not from an excluded activity, it's 0. So what is the situation that we're dealing with is you are transacting with people inside the same free zone or in another free zone. That would put you in the 0% bucket unless it's an excluded activity. When it comes to dealing with a non-free zone person, so in our view, that's mainland and a third country, we have a bucket of qualifying income and that same bucket of excluded activities. I'm going to reuse that same bucket again. For those entities, excluded activities 9%, qualifying activities 0%, and then this is where my third magic bucket comes. I have something in between potentially, which is not really defined, but which we term as a non-qualifying activity. That non-qualifying activity bucket is also acknowledged when we look at the de minimis that Reggie was referring to, which is that 5% or the 5 million. The lower of the two, if you exceed that de minimis requirement, in other words, if you have non-qualifying or if you have excluded activities and those are relatively important, and relatively important is considered 5% in the overall revenue of your entity, then you lose the benefit of being a qualifying free zone person for the year itself and the 4 years after that. So it's quite an important thing to look at. I've narrowed those buckets down further. This is just the same thing, but then zoomed in. You can see that if you're dealing with another free zone person, there's only 2 options. If you're a qualifying free zone person, this is the same graph, but zoomed in at a higher level. Yeah. If you're not a qualifying free zone person, for example, because you don't meet the substance requirements in the free zone, then you're completely out for all of your revenue. If you are a qualifying free zone person and you haven't opted in and you are compliant with transfer pricing requirements, then we need to look at all of those different buckets. Again, this is just a zoom in as well for you to find your way. Same thing for the immovable property as well and for the permanent establishments. The de minimis I already explained, so I'll perhaps not dwell on this much further. If there's any questions on that, though, we can take them as part of the Q&A. Now, what are those qualifying activities? And I will say that in our view, the list is rather restrictive, and perhaps we, the tax advisors community, I don't know if Reggie or Tim would share the same observation or conclusion as well. We were expecting a broader list of qualifying activities. Yeah. So those qualifying activities are, when you deal with a non-free zone person, allow you nonetheless to have 0% to be applicable. And where I was expecting a broader list, or maybe simply a 0%, is when we're dealing with third countries. Yeah? A free zone is meant to do business internationally, so why are we restricting the 0% when it comes to international business? But that's my humble view. So as qualifying activities, you can see them on the screen, so you can manufacture in a free zone. I'm guessing, Khalid, not many factories in Meydan free zone. Processing of goods or materials. The holding of shares, so if you have a holding company in Meydan, that is a qualifying activity. So that's helpful if your UAE entity is maybe a regional holding company with different subsidiaries throughout MENA, which is relatively common. Ownership, management, and operations of ships as well. Reinsurance services, fund management services. Wealth and investment management services as well. Maybe more important is headquarters services and financing to related parties. That is qualifying income. So what you see is for a regional holding company that holds shares in other companies abroad and provides financing and provides headquarters services, that's qualifying income. So that's quite good. However, I would add to that is that we don't have a definition of what are headquarters services. And what we see is that there's a whole range of more admin services or services which would normally term as professional services, admin, legal, tax, accounting. They don't fall into that bucket of qualifying activities, even though they might be provided to a recipient abroad. Financing and leasing of aircraft as well. Distribution from a designated zone, unless the list has been updated. I don't think Meydan is a designated zone. There's no fence. Everybody's welcome in Meydan. Logistics services, and then any activities ancillary to the above. So the qualifying list is important when you're dealing with a non-free zone person, as you've seen in the graphs. We have excluded activities as well. Those are, a couple of them are these regulated financial services, I would say, banking, insurance, and so on. Finance and leasing, but also intellectual property, which is held. So if you hold an intellectual property and you license it, it's an excluded activity. That might be perhaps a bit regretful. And then certain transactions as well with natural persons. When we look at the free zone persons, what is important as well, and I'm repeating myself slightly, but and I won't go into every aspect on the side, but those audited financial statements are really important. And that is a requirement that is going to come earlier than what you think, because your 2024 is based on your 2023, and the law says your end point at 2023 is the starting point for 2024. So essentially, in practice, you already need very good financial records, and in my view, you already need audited financials as well for 2023, because that's going to be the basis that you're going to be building on to calculate your tax liability into next year. Administration, yeah, some of you are looking at administration within the organizations that you're active in. As already alluded to, number one is the registration. It's a bit confusing, if I'd be honest, right now, who can, who cannot register. They launched the registration in January. We were on the ball. Within an hour, we tried to register. Within 5 minutes, we had our number. Amazing. Much quicker than getting a VAT number or getting rid of a VAT number. Some of you might have experienced that. The number is different from the VAT number. Tim already alluded to it. Structures can be different. Yeah. VAT groups are not the same as tax groups. So the number, the TIN number for CIT purposes is different from the VAT number. It doesn't really matter much because you don't have to quote it in any document. It doesn't go on your invoice or anything. So that doesn't really matter much. The FTA has said a couple of weeks ago that they wanted the free zone entities to wait for a bit until they register. So I would say be on the lookout for an announcement, although actually in practice it's very likely that you'll be able to. There are certain complications. The system doesn't foresee for the possibility that you have a foreign parent, for example. If you have a foreign parent or any parent, they ask for a trade license, and in many countries don't operate with trade license, so that's sometimes a bit of a complication. I'm being reminded of the time. Deregistration, I wouldn't dwell on that for too long right now. Let's just first register, and then let's deregister later on if you ever liquidate your company. CIT return filing, no advance filing, no information filing for now. 9 months after the end of the financial year, filing and payments. We don't know yet what the return is going to be looking like. Judging from how the law is designed, I do expect that for qualifying free zone persons, there may be a couple of additional requirements in order for you for the FTA to be sure that you meet the conditions. Very likely in other jurisdictions, there's often additional schedules also requested. For now, we don't have any difference between, when I say for now, between the accounting depreciation and the tax depreciation. At least so far, there doesn't seem to be any suggestion that there will be. And that would also likely reduce the amount of schedules which will be required for the filing of the CIT return. Self-assessment system, yeah, there's no one who's going to come to your office and say have actually done this correct. So it's the same thing as with VAT. You need to do it correct, yeah. Buyer beware. Essentially, you need to know the law. If you make a mistake, here comes the stick, and you'll be punished. So it's going to work in this exact same way as for VAT purposes. I would say we are lucky, though, that recently, 2 years ago, the penalties under the federal tax procedure law were reduced. And there's many more possibilities to correct as well. So likely we will not have the same potential very big impact as we had with VAT of potential mistakes made. Documentation to be held for 7 years, financial statements as mentioned. If you're a QFZP, so qualifying free zone person, you always need audited financial statements. For mainland companies, if you're below 50 million, it is not required. This is not a road or not buckets, but maybe a couple of steps. Yeah, if you're an entity with revenues below 3 million dirhams, you can benefit from small business relief. If you're below 50 million, you can apply IFRS for SMEs. I'm a lawyer. Don't ask me too many accounting questions. I've learned my share, but I'm not the expert. Above 50 million, you are required to have financial statements according to the normal IFRS rules. And then we have two other buckets, which I hope you're in, because it would mean that Maidana is hugely successful. Above 200 million dirhams, not just audited financial statements, but also have TP documentation requirements applicable to you. And that final bucket is if you're a large corporate with a consolidated turnover in excess of 3.15 billion, Reggie alluded to it already, they may be required to pay a minimum rate of 15% on profits in the UAE. I'm not going fast enough. So despite the fact that I'm a lawyer, I can talk a bit too about accounting. I think a lot of companies are doing disclosures in their financial statements to understand what the impact is going to be towards the future. Provisions may be important, end of service provisions that you take into the future. Doubtful receivables as well. Those will have an importance. And later on, let's say that you have losses, that would be a deferred tax asset that you take with you. So there are a couple of things from an accounting point of view that you need to do, and especially for free-zone persons, we need to be able to segregate those types of activities to demonstrate that we've applied this correctly as well. That is over and above your IFRS for SMEs. Reggie alluded to it, VAT. Very likely the FTA has a very audit approach to things, as in statutory audit approach to things, and they like to reconcile a lot. So they will very likely ask you for a reconciliation between your FS and your CIT return and your VAT returns, as they sometimes do for VAT purposes now as well. I'm a bit of a talker, as you can see, and I'm out of time. Just very quickly on this one, I'll just leave you with this. There's a couple of considerations from a legal point of view that you might want to take into account. I would say that for lack of a better word, the impact assessment in the beginning, right now, essentially a photo of your structure and understand how it applies, and then how it could apply alternatively is going to be very important. And if that means that you need to restructure a bit your group and your different entities in the UAE, that will involve lawyers, some of Adnan's colleagues at Clyde Co perhaps, in order to restructure those different businesses. My time is up. So the slides will be made available, but maybe I'll get Adnan back on the stage, and then for anything that we haven't covered, we can cover in the Q&A perhaps still. Thank you very much.
Thank you, Thomas. That was very useful. I was just sat there thinking that UAE, being a regional CFO, I look at countries across the region, and every country that we look at has got taxes except for UAE. UAE is the latest one that had taxes. And then it dawned on me that the famous saying, death and taxes are certain in life, is true now for us as well here. And on that grim note, I'll give you a 10-minute break, and after the break, we will have a Q&A panel session. So if you, as I said, if you have a question and you don't want to ask, please write it down, pass it over, and I can ask on your behalf. Or if you want, mics will be going around and you can ask your questions. Now, before we start, you would have received this card when you entered the building, or you may find one lying around somewhere. If you scan this, this is one way to get the presentations and the videos for the evening. So please make sure you do that, otherwise you won't be able to get that. There's that on the screen as well, so if you can use that to register now, we'll make sure that you get the slides and the video for the presentations done earlier. So the format is pretty simple. I'll ask the questions, panelist here will answer. We've got a very shy audience because everyone, or most people, decided to write the questions down rather than use the mic. So I've got an army of questions here. But I'd still like to start with the audience first. If anyone here is brave enough to ask the first question. Hey, young man, there you are. Can we just get the mic over, please?
Hello. My name is Sergey. Thank you for the presentations. They are really useful. I have several questions. But regarding one topic, small business tax relief. So is there any procedure or rule for the company to elect to apply small business tax relief, does the company, for example, a free zone entity, need to explicitly apply, elect to apply corporate tax, as, for example, if it's a qualifying free zone person? And I think that's all of my questions. Yeah.
Thank you. Thomas, do you want to take that?
Sure. To the best of my knowledge, I don't think there's currently a procedure which is applicable to apply for it. I think there may be one further down the line, and obviously the FTA is going to want to verify whether you're below the 3 million dirham revenue threshold or not. So I do suspect that despite the fact that you won't have to pay any taxes, you will have to file for them to verify that you're still below that threshold. Yeah.
Okay. So now there aren't any procedures or rules for applying for a small tax relief, as you said.
Sorry, again?
There aren't any rules or procedures to elect to apply small business tax relief right now.
I don't believe, to my knowledge, that there are any right now. Yeah, that's right. Okay.
Yeah.
See,
Okay.
I'm backed up here. So that's good. Yeah. So I think that's probably one to watch now. In the next couple of weeks and months, I think it's probably good for all of yourselves to get a couple of sources of people who you follow on social media and whatnot to get some information, because it's almost constant. For us, it's hard to keep up. So I do think that the FTA is going to put in a couple of processes in place, for example, to apply for this, or maybe a form, or there will be a process which will be disclosed. And the same thing holds for a range of other elements as well of the law, including potentially for qualifying free zone persons, and for you to demonstrate that you actually qualify.
Okay, thank you. Thank you.
Pleasure.
Hi, Simon from Park Lane Motors. We're based in the Maidan Hotel, and we're just trying to establish whether we are going to be charged or not. We're trying to find a section that we fit into because we purchase and retail vehicles. So we're assuming it would be goods and services. Do you think that would apply and we would be paying the tax?
Tim, do you want to take that?
I see that Thomas has the list in front of him.
Just to reconfirm, you're purchasing automobiles?
Yes,
Yeah.
and retailing as well, yes, and exporting.
I don't think you'll have a qualifying activity, and I don't think you'll have a excluded activity. Although you're dealing with natural persons, likely that's an excluded activity.
Because manufacturing of goods and services, processing of goods and services. So this is a distribution. We have on the second slide, we have distribution. Meets relevant conditions and logistic services. Do we have sufficient information to conclude with this, Thomas?
Sorry, I'm not sure if everybody heard that, because I think Tim's microphone was I don't know if you switched it on or... I switched. It's on. Testing, yeah. I think one complication with some of these definitions is, some of those qualifying activities is that they aren't defined. So I think I don't see you falling into one of the qualifying activities unless you're maybe supplying those cars from a designated zone, which you're not. I think they're not in a bonded zone. So I think you could fall into the excluded bucket for transactions with natural persons. So yeah, you're going to have to see first off who you're buying, who you're selling to. That's going to be determining whether you got 0% or 9%. It looks like if you are dealing with other free zone persons buyers, but that's actually a natural person, then that is going to be 9%. Yeah.
Okay, thank you.
Pleasure. Any transactions with natural persons, with certain exceptions, yeah. Which is a bit of, and I've asked myself that question. I don't know if my colleagues can answer that or not, but the excluded activities have a part which says transactions with natural persons, but those excluded activities are important for when you deal with free zone persons. So it doesn't, I'm not sure how to read this, to be honest.
Hi, my name is Shweta. I'm from Enter Markets Management Consultancy. So we have a couple of SPVs in the ADGM set up. How would that work with the CT? Because some of these SPVs have operating companies under them. So how would the administration of CT work for these?
Reggie, do you want to take
And
that?
these operating companies, for instance, are in the Maidan Free Zone.
Well, so I think every entity will be looked upon on its own. The fact that you have an SPV in the ADGM initially means you cannot really have a fiscal group because the SPV is in a free zone. The SPV on its own, I would imagine, could either be providing headquarter type services to its affiliates or treasury or finance type services to its affiliates. Plus, it will be obviously be owning shares and earning distributed dividends. So, in essence, it should qualify as a qualifying activity on its own, right? But each of its subsidiaries would have to be looked at differently to see what they do, who they supply services to or sell goods to. So they might end up having to pay tax, whilst the SPV in its own would not be subject to tax. One of the things you have to be careful with the SPVs is by definition the SPVs may not actually have substance, right? Because the SPVs tend to be managed by corporate service suppliers, yeah, in the very strict sense. If that's the case, then you may not, for that reason, qualify as a qualifying free zone person. So one of the things you should do is to review the constituency of that SPV. And if you don't have a management within the SPV, you'll try to do so that you can qualify. So you just look at the 6 conditions that you need to meet and then qualify.
But
Yeah,
if
and
the
the-
SPV has an office space, does it qualify as substance?
Yes, yeah. So you need to have office space, you need to have the personnel, you need to have the expenditure that matches the activities that you undertake.
Got it. Thank you so much.
And in addition to that, so holding of shares is a qualifying activity for the 0% test. But in case you also have if you would be subject to the normal rules, so that also applies to any other entity in the UE which is normally taxable with 9%. You also have the participation exemption.
Can you repeat that? We can't hear you.
Maybe I just have to talk louder then. You also have the participation exemption rules, which is a regime which will exempt income from shares derived from mainland companies. So that there are multiple ways to get to a 0% outcome in respect of dividend income on shares and capital gains on shares.
Thank you so much.
We'll just go to the questions that have been handed in. So Reggie talked about economic substance. So there's a few questions, different varieties of economic substance questions. So what constitutes adequate economic substance? And one question actually asks, does that also is the same definition as ESR?
No, so the ESL is very detailed regulations that would suggest if you're undertaking specific relevant activities, and then each of those activities have to be defined, then you need to meet the different substance tests that are applicable to those activities. And then that comes with compliance obligations, your notification, and your reporting. But the adequate economic substance is a different matter. That is to enable you to meet one of the conditions for being a qualifying free zone person. So there are different, there's different regulations. For example, you could be a mainland entity and you need to meet the economic substance regulations, right? But then if you're a free zone person and you want to meet the conditions required to have a 0%, then you must meet the adequate substance. What I can say though is if you need to meet the economic substance regulations, which is the more detailed one, and you meet those, then you would have met the adequate substance. So you don't have to comply with two different regulations. But if you're, but you shouldn't feel that they're the same. They're both very different. Yes. It's possible that in the end, the tax authority might, or not the tax authority, the government might decide not to abolish the economic substance regulations, because meeting the adequate substance effectively achieves the aim of ensuring that companies with substance are able, only companies with substance are able to get the tax relief.
Yeah, that's an interesting point that you make there, Reggie. So, because the law doesn't directly refer to the ESR regulations, but it uses the same terminology when it says a qualifying free zone person shall undertake its core income generating activities, and that is a definition that comes out of the ESR rules. It says in a free zone, having regard to its level activities carried out, adequate assets and adequate number of qualified employees, and incur, as you rightly point out, Reggie, an adequate amount of operating expenditure. What is also interesting is that activities can be outsourced, so you can still meet this requirement, even if you outsource your activities, but then that needs to be outsourced to a party within the free zone. That can be a related party or an unrelated party, but then you need to have appropriate supervision over the outsourced activity within the free zone.
Maybe to add still on that as well is, it's a bit same but different, I would say, between ESR and the substance requirements. There is the difference indeed in terms of the outsourcing. There's another difference, which is the directed and managed criterion, which you find for ESR purposes is not there for the purposes of meeting substance requirements for a qualifying free zone person. So I think that's a relatively a big difference between the two. As to how much substance you actually require, in some other countries they have an approach where they say if you meet a minimum bar of this much payroll or this big of an office, then you meet it. In the UAE it's not the case. The choice was made to have a system where you say the substance needs to be commensurate to the activity that you develop. And for a number of entities, if you're a passive holding company, well, you actually don't need a lot of substance. And that's also what the guidance acknowledges. They say you just need to meet the regulatory requirements of the zone in which you're located. So I would expect that likely we will see a relatively similar approach of the FTA towards the substance requirements for the QFZPs and economic substance regulations.
Yeah, so I think it would be fair to say the ESR is a lot more detailed, whilst the adequate substance requirements for tax is a bit more circumstantial. So it would just depend on what activities you have. So it means that there's an element for you to demonstrate. Whilst with the ESR, you don't have that much discretion to convince about your position. There's also one subtle distinction. So the adequate substance rules for tax says if you're undertaking core income generating activities, those activities could be outsourced to someone within a free zone, right? But the ESR says you can outsource your activities within the UAE so long as you can supervise. So not free zone, but within the UAE. And the other subtle thing is the outsourcing for the ESR can be any activity, right? So your administrative support that supports your core income generating activities, you can outsource within the UAE. But the outsourcing within the tax law is only for your core income generating activity, right? So there's a bit little distinction. It's not really clear. It's not pronounced, but it's subtle. So firstly, what's your core income generating activity? Then you can outsource that, right? But it means that if something is not your core income generating activity, you can outsource it to anywhere. So there are big distinctions, but on the face of it, it looks like it's the same, but it's not really the same.
Thank you. Now we go back to the audience. Any questions?
Yes.
Yeah.
Yes.
Sorry.
This is Jawad Dilavar. I'm a lawyer from Topworth. I have a question from Mr. Thomas. The government has levied corporate tax 9% on mainland. Now, my clients are now anticipating we should move towards free zone or it should remain over here?
Good question. Maybe more business for Maidan Free Zone. It's a very interesting question because, for example, when you compare to Saudi Arabia, where you have the ILBZ, which is, they call it a special economic zone, but it's a free zone, but Saudi style, they actually have a provision that says you cannot move from mainland into the ILBZ. And they will have the same provision for the 4 special economic zones which were recently announced. And so far, we don't see anything along those lines. Now, if you would have an activity that you're conducting currently in the mainland, and you would move that to the free zone, but you continue to conduct business with the mainland, then there's a relatively high chance that you won't have qualifying activities. So I think the risk from a revenue perspective for the FTA is maybe there, but it's perhaps not as pronounced, really. And I think in a restructuring for this purpose, there's also an anti-avoidance rule in the law, which applies broadly, not just for businesses moving from mainland to free zone. And there, in a nutshell, I mean, we would call it the principal purpose test, but in a nutshell, let's say you need to find a business rationale for why you're doing that, right? If you lack that business rationale, then the FTA will say, well, you moved into a free zone, but actually this was only for the purposes of obtaining a tax advantage, and then they will consider you as a non-qualifying free zone person. So there, yes, it's possible, but I would say there's a couple of attention points, and finding that business rationale is important. A business rationale could be, in my view, but it's going to be very much subject to the discretion of the FTA. If you have a regional headquarter in the UAE, and you have headquarter services financing from the UAE mainland for entities abroad, then actually you might consider that you're in a better place in the free zone. If then you find a good rationale, I don't know, availability of offices, better legal framework, a couple of these kind of things, then you might have a defensible position towards the FTA to restructure that.
And to add to that, perhaps you can still have tax benefits as long as the commercial drivers are predominant.
Yeah.
And Reggie, from your perspective, from a legal angle, how do you see that playing out?
Yeah, so I was about to say, so what you guys should now be focusing on is the tax law has become effective now. So 1st of June, we're in the tax law biosphere. And then the legal aspects then become quite important. And it's nice to say you can do different things, and you can move and shift and do things for business restructuring purposes. But once you're in the legal biosphere, whatever you do can be subject to dispute, right? And so it is critical that you have contemporaneous documentation of everything you do. So Thomas mentions the business rationale. That business rationale should be documented at the time at which you take it. So you can't go back 9 months and say, 9 months ago, this is what we thought about. Because if you don't have the documentation signed and effective, if you now have to go to the court or to the tax appeals committee to prove what you've done, without the documentation, it wouldn't work. So because we're now in the tax regime, 1st of June, whatever you do, I would just say, just make sure it's well thought out and then properly documented. That's critical, right? If I can oversimplify it, that's the way I would say it. Yeah.
I'm sure many of us had the same question here, so hopefully that answers it. I'll go back to
Thank you. My name is Mikhail. I have a question regarding the qualified activities. I believe that the list of qualified activities is not too detailed as of today. So one of the activities is holding of shares and other securities, which I assume shows us that, for example, having on the balance of the company corporate bonds and then getting some profits from them would be exempt from tax, assuming that other conditions are met. But for example, do you believe that capital gains from investment in shares and other securities would be released from taxation in this case? And going further, would this kind of, I don't know, investment or trading activity in securities would be released from taxation? And if not, then who is actually evaluating that? Will the tax authorities come and say that, okay, we believe that it was above the permitted thresholds, and so then you are subject to 9% tax? Will, in this case, 375,000 threshold apply? Or will it be the penalty for not paying tax because of the conditions are not met? How will this work actually?
I think both me and Tim want to give a reply on that. I think Tim in part already gave a reply on it before. Even if you would not qualify, you also have the participation exemption, which would exempt dividends and capital gains if you got more than 5%.
It's for the shares, yes, but
yeah.
If we speak about the bonds, for example.
Indeed, yeah, it doesn't apply to bonds, for example. Indeed, holding of shares and other securities is not defined, and that's potentially a bit of an issue. We need to see securities, how far it will go. I will say, linked to that, before I maybe hand over, is we didn't talk much about natural persons. Now, natural persons, they have a couple of categories which are excluded from business income. Yeah, it's real estate income, it's their wage, but also investment income. And some people that we are assisting that are maybe holding participations in other entities, which is essentially just their piggy bank. Sorry for the haram reference, but their piggy bank for the later saving, to take them out of that company. Because if they're in the company, there's indeed the question, is it a qualifying activity or not? Does the participation exemption apply for shares or not? If it is really investment for your personal purposes, and maybe you've put that into a company before because you want to shield yourself from liability and whatnot, you may actually have a better option in taking them out. And we saw the same thing, for example, for real estate. There's quite some real estate which is held through companies as well. When that's your private residence and you're living in it, it doesn't actually make a lot of sense to hold that through a company. And if there's a possibility, it's better to take it out, because if you're going to sell it on later on, you will have capital gains on a difference. And the real estate market is currently quite high, so that might be a 9% that you don't want to have. Sorry, maybe I said things that you also wanted to say.
No, that's spot on. Those three categories are carved out for natural persons. But the remainder is taxable if you meet a threshold of, I believe, 1 million dirham.
Yeah.
I haven't looked at these rules in detail because that's not usually our client base. But that's how the rules work. Another point on immovable property, what's perhaps relevant, is that immovable property is defined in one of the latest ministerial decisions, the one on Nexus, I believe, and it means the land. It means everything that is built on the land and everything that is permanently attached to the land. So that is considered immovable property, so that's a broad definition. And if a foreign entity owns immovable property, then also this foreign entity needs to register with the tax authorities and file a tax return accordingly.
That's one of the questions that I was going to ask next. So whoever had that question, I think is Trisha from PFC, Infinity Management Consultancy, had the same question. We've got a few questions around where can you find qualifying activities or list of qualifying persons. I mean, that's available online. The slides that we're going to share will have those as well. So please look at those. If you need more detail, where can we find more details?
Number 55 and 139 are the numbers.
It's not bingo today, but I think the website of the Federal Tax Authority would be a good place to start.
Yeah. There is a specific question though on the if you've got a non-profit in a free zone, what would the impact of corporation tax be on that?
So for non-profits, they can be a qualifying public benefit entity, and There's a couple of conditions, for example, that obviously the non-profit entity cannot be conducting a business, or even if it does, then the business needs to be ancillary to the main purpose. There's a list of qualifying public benefit entities. There's a couple of interesting associations there. The chess association, the Indian Women Chess Association, for example. But you don't necessarily have to be on that list to be a qualifying public benefit entity. What is probably interesting for the non-profit as well is if you meet the conditions, then if you as a corporate, you make a donation to the non-profit, then that's a tax-deductible donation. So that's quite an interesting one.
And there, the list for the QBPEs, the qualifying public benefit entities, is out. It's attached to the decision on this one. But there's also a process. So if you're not on the list already, but you believe you meet the requirements, there is a process to be added to the list.
Okay, thank you. Any questions from?
Yeah. This is Onur from Mon Consultancy. I have a question about designated and undesignated zones. Is there any difference between designated and undesignated zone about enjoying corporate tax? If I may detail this, if you're a trading company, you are getting from abroad and selling abroad, maybe not in the mainland, is there any difference being with Meydan or Dubai World Trade Center to DAFSA or JAFSA? The first question. The second question, if I may, about dividends. Is there anything about taxable and dividend part? Thank you.
Yes, so that's a question that I have on my sheets as well. Reggie, do you mind taking that?
So yes, some of the qualifying activities are restricted to designated zones. And one of them, for example, is the distribution. So you have to sell goods from or within the designated zone. And those goods have to be sold to resellers or companies that would effectively process the goods. If you're doing the selling of goods from, say, so Meydan zone, for example, is not a designated zone. Designated zones are essentially zones that are kind of security ring-fenced. And not only that, they're actually itemized. They are listed. So in Dubai, for example, DAFSA, Dubai Airport Free Zone, JAFSA, and a couple of other ones are the designated zones. You have 2 in Abu Dhabi and maybe 2 in Sharjah. So those specific ones qualify as designated zones. And then the activities, there are about 2 active. One of them is manufacturing, and so long as those are happening in designated zones, then they're okay. And the designated zones definition is also the same for excise tax as well as VAT. Yeah. Does that help?
Yeah. Maybe to add as well, because we get the question quite often for trading entities, if you're buying from a third country and selling to a third country, it's not a qualifying activity. And that's a bit of a, I'd say, regretful situation. So if the goods never come to the UAE, then that's not a qualifying activity.
Then another question then, if you are in JAFSA, if you are in JAFSA and you are getting from JAFSA another free zone company and selling the third country, does it make any difference?
So it says that you can sell from a designated zone to a reseller. The interesting thing there is it doesn't really say whether the reseller needs to be mainland or not. I don't know. I can only speculate. Maybe the other gentlemen have a...
It doesn't matter. I mean, so long as you are a distributor and the reseller is doing exactly what it's required, the place of business of the reseller is not relevant. What's most relevant is your place of business. But if you're buying from, say, Japan and you're selling to France, and the goods never come into here.
Trans-trade, yeah, it happens a lot.
Just trading.
Yeah.
Then it is then a play on whether you're trading from the designated zone or from within, right? That needs to be clear. But if you're not, if you're a Meydan free zone entity, and you're buying from Japan and selling to France, and it never comes into anywhere, then it would not be a qualifying activity. You'd be subject to tax at 9%.
In JAFSA, you mean that you can be then, if it's a transit trade?
If it's from,
Japan to France.
From, yeah. I think that is a point that is not really clear from the qualifying activity. I think the prudent view to take is that you may not qualify because it never came into the zone. Right?
Sorry to make it long, because of the tax.
We'll have to start charging you for these.
Oh,
for this
thank
advice.
you. Thank you.
Reg is very expensive.
Maybe a lot of people ask it. Thank you so much.
Yeah.
So if it's a third-party logistic company to do this for you, would that still be?
If the goods are coming into JAFSA,
Yes.
and you're working with a third-party logistic provider, and you're registered in JAFSA,
No, you listed Meda.
no, it wouldn't work. But the logistics provider that is registered in JAFSA is undertaking a qualifying activity because logistics services are qualifying activities. Yeah.
So if you do trading using third party, you still have to pay the tax.
If you're a Maidan,
Yes.
because Maidan is not designated. Yeah.
I think Khalid is going to put up a fence soon in Maidan.
Okay.
We've got a question at the back there.
Yeah. So on this point only, so designated free zone is supplying goods. Supplying goods to foreign party. Okay, but that good doesn't enter into the designated zone. So as I understand, it's a taxable, right? It's not considered qualifying activities. So is that correct understanding?
Yes.
Yeah, I think Reggie is a bit more cautious than I am on that. But yeah, it is. I think it will be subject to 9%.
Okay.
But I agree. It's a very important part, and it's my interpretation. It doesn't come from any example given by the FTA or anything. So that's probably a space to watch. Yeah,
okay.
As so many that we mentioned today.
Yeah, we have to be mindful here that when the consultation document came out, which preceded the law, then there was a consultation process over the course of the last summer. At that point in time, it was the clear intention in that consultation document that any transactions with outside of the country would be carved out from the normal tax regime. But that is not repeated in the same easy way in the current tax law.
Okay. And so Maidan Free Zone Company having office spaces in inland. Okay, so that will consider as for substance requirement for TP purposes.
So if your office is in the mainland.
Yeah. So Maidan Free Zone Company
Yes.
have office space in mainland.
Right.
So is that considered as substance fulfillment for TP purposes?
I think it's a slightly different dimension. If your office in the mainland is doing business, right, that office in the mainland will be regarded as what is called a domestic permanent establishment, right, and that the income from that office will be subject to tax.
Okay.
Yeah. If the only adequate substance issue, the one you're referring to, is if your what they call core income generating activity is outsourced to someone in another free zone. If it's outsourced to the mainland, it doesn't work, right? But if you have a branch or an office in the mainland, that branch or office in the mainland, the income of that branch or office in the mainland would be subject to tax on its own.
Yeah. Even if you outsource to a free zone, you still need to supervise from within the free zone, not from in the mainland.
Yeah. So in that case, a Maidan Free Zone doesn't provide office space facility. Okay. And so Maidan Free Zone companies are taking free office space in inland. So they are not establishing a branch, but they are taking space in the name of a Maidan Free Zone. So is that considered as a substance provenance for free zone company? That's my question.
I mean, by the strict wording, no, it would not qualify as substance.
Okay. Okay. Thank you.
Before we move on to more admin and registration type questions. Admin and registration type questions. We've got another one here.
I actually have two questions. The first one is I just want to reconfirm. So if the person owns real estate and rents it out for the purpose of income, will it be taxable or no?
Generally speaking, yes, 9%. You're talking about a person though, a private person?
Yes, a natural person.
No. Irrespective of the volume of the revenue, you can own 10 villas on the Palm and earn 5 million dirhams in rental income annually, not subject to corporate income tax.
And the second one, also like to reconfirm, because we heard different questions on that matter and different answers. So if the company is registered in a free zone and all the supply, so all the goods are moving outside, so they don't even come in UAE, so it's direct shipment, say from Italy to France, okay? But the payment is transferred to the UAE account. So will this revenue be taxable, be considered taxable or no?
I think the safe assumption for now is to consider that it is. Yeah. It's always better to have a positive surprise when the FTA clarifies something rather than a negative one.
So there is no clarification yet, right?
There isn't. So I think what you could hear from the debate is there could be different ways of reading things. At least in our view, when in a triangulation situation, and you're B in the middle, the goods are not coming to a designated zone, then we believe that you don't qualify.
So this revenue will be
9%.
Taxable.
Yeah.
Okay, thank you.
Yeah. If it is a very, very small proportion, if it's less than 5% or less than 5 million of the overall, and you do have qualifying activities for the rest, then you can forget about that because it would fall under the de minimis, and that you would ignore that and still have 0%. Yeah.
Thank you so much.
Pleasure.
There's a question at the back there. Another one there.
Hi, good afternoon. We are a metal trading company. And we want to understand on the hedging income, it is taxable. We are registered in a Jabza free zone.
Hedging on what? Hedging on?
Hedging of copper.
Okay, so.
Metals.
My answer would be that there are situations where hedging results on shares could be exempt under a participation exemption. However, if it's on metal, on commodities, then I would be inclined to say that's taxable.
One more question.
I think it also depends on whether it's a gain or a loss on the hedge as well, right? So it's the accounting treatment. You follow the accounting treatment for that in the first instance. A lot of these things you have to follow IFRS with these, and then you can determine whether that's a yes or a no.
Thank you. One more question I want to add on the free zone. We are in a designated zone, as most of the questions are coming that the goods are not routing through the UAE port. So if someone takes a warehouse in free zone and the goods enter and then he makes a resale, then it will be qualify or how?
Yes. So
qualified.
Designated.
Yeah,
it needs to be a designated.
If it comes into the free zone, then it would qualify because it's from within the free zone.
So the government will not see that, okay, you have created a warehouse just to avoid the tax?
Well, that's what the government wants you to do. They want the goods to be in the free. It wants the goods to be in the designated.
Because you are not doing any reprocessing. You are just bringing the goods and you are reselling it.
So if you buy them in, you import them from someone else, you put them in the warehouse, and you sell to a reseller, then you qualify. It falls within the definition of a qualifying activity or one of those activities, which is the distribution of products to resellers.
What if you sell it to the end consumer?
If you sell it to the end consumer, then that doesn't work. It has to be sold to a reseller.
Okay. Thank you.
Afternoon. I have a question that probably most over here, that most SMEs will be interested in. The corporate tax law says that you have to pay 9% on net profit, correct? Is there a definition as to how you get to that net profit?
Yep. So I'll take that being an accountant. The rest are lawyers. So there are definitions around that. Obviously, you have to follow the accounting standards to make sure you achieve that. Those accounting standards need to be applied consistently. You can't pick and choose what accounting standards. So it has been mandated that you have to follow IFRS. Right?
Okay. So from an SME point of view, so a lot of SMEs where the owners work actively in the business. So technically speaking, an owner would then, for example, take a dividend at the end of the year from the profit.
Be a connected person, my friend. So we haven't touched upon that. Connected person is something invented in the UAE to target specifically the situation of shareholders, directors, managers, officers in a company inflate their salaries, which would make a tax deductible expense, and therefore reduce the taxable base. So if you are one of those connected persons, you will have to demonstrate towards the FTA that you're worth your money. In essence, you need to demonstrate what would be the fair market value of your salary. And it's a bit of a complicated thing because they refer back to transfer pricing. And for transfer pricing, we have things like benchmarks and whatnot, but we don't have a database which says person A in this position should be making this much. So that might be, I foresee that might trigger some complexities. What you could do, for example, in a company is, if you're the shareholder, a safe thing would be to pay yourself as much as the next highest earner. You would always comply there. But if you're pushing it and you're paying yourself double that salary, then you better be worth it.
Yeah, and in the connected persons definition, there's also a bit of an anti-abuse element. So it is not only, doesn't only apply to the director/shareholder, but also to all its related persons, like its family, until the 4th level of kinship, if I'm not mistaken.
Yes.
So what you cannot do is put your whole family on the payroll and erode the tax base in that way. That is not going to work.
Unless maybe your family is very talented, Tim.
Yeah. If they're worth their money, you can, but then they...
So creative accounting doesn't really apply here in that respect. Okay.
I'd be very careful with creative
you can try
accounting.
it.
But for example, what you said, Tom, it's the connected person. Could you, for example, circumvent that by, if you're the owner of the company, by giving yourself an employment contract? So you're actually being paid a salary.
So it's the same thing. So if you're the owner of a company, you can indeed pay yourself a salary. If you're a shareholder of a company and currently you're only living off of the dividends or whatever cash is in there, you are allowed to give yourself an employment contract and pay yourself a salary. As long as that is up to market standards, that's completely fine. So if today you are operating in a company and you're only living off of the dividends, then that is a way to reduce the tax base, and it is legal. It's not creative accounting or anything. But indeed, there is that caveat that you need to demonstrate that that's the right salary, which is difficult because if you always think that you're worth more than your employer thinks you are, right? So it's a difficult judgment.
Okay.
Yeah, but it's also good housekeeping because I think many small businesses don't actually pay their owners or proprietors for the work they do. Right? So if you're doing that, you're just giving money away to the tax authority.
Yeah.
So as a matter of housekeeping, it's important to check to see what your role is, what your functions are, and in order to make sure that the evidence is robust enough, it's advisable you can get some HR company to give you some sort of analysis or survey of what's appropriate. I mean, what the market is paying for a role that is similar. And so that way the evidence is extraneous, it's not something you manufactured, and you can utilize that to demonstrate to the tax authority that this is the proper salary. If you're not paying yourself a salary when you're actually doing work, you're just giving away money, so it's not, it's negligent on your part.
Okay,
so it's
thank you.
You should do.
Questions at the back there? Sorry, we'll take yours first, yeah.
Yeah, regarding the real estate about the natural person, if the same real estate is owned through SPVs or family foundation or trust to manage the inheritance law or English common law, whether those properties income will be still taxable?
So what you should be doing, so there's always the tension between wanting to own your properties in a company because you want to avoid the liability, right? And secondly, for succession planning.
Yeah.
And so the best way, maybe you might need to come to me for more advice, but the best way to handle this is you could use a foundation, right? A foundation is a corporate entity.
Yeah.
The foundation can own the property, and that way you avoid the risks of the liability, plus you enable your succession planning. But what you do for tax purposes is you make an election. You make an election that the foundation becomes transparent, which means you, the owner of the foundation, will become the taxable person. And if you're just an individual rather than a company, you avoid having to pay tax because you're an individual, right? So you eat your cake and have it. You avoid having to pay tax. And then you get your corporate protection because you have a foundation. And it enables you to do your succession planning because you have a foundation.
Okay, so with the foundation will not be taxable, right?
Yes, but if you use an SPV, which is like a normal company, it's not possible to make that election.
Okay. Okay, second question regarding, you say the company may transfer from mainland to free zones. It may consider by FTA as tax avoidance. But looking at last 1 year, how the Dubai market is going, all the consultants from Big Four to anyone, they are coming out with a gap analysis or giving their recommendations, how you structure your group structuring or corporate side. And that is purely a business, not a business rationale, this is purely a tax rationale, no tax planning rationale everyone is doing. So how FTA is going to look at that? Because there is no other reason right now if people are moving from mainland to free zone or any other reason, like this is, right?
I mean, I'm the only one in the Big Four, so maybe I should take this one. What I advise all my clients is, if you do, this is your snapshot, this is your impact assessment. If you don't do anything, this is your situation. This is how you will be taxed. You can do this, but you can only do this if you have commercial reasons to do this. And before we provide a piece of tax advice, we discuss with our clients what are their commercial drivers, what is their agenda, how is their 5 to 10 year outlook, where do we want to be, where do they see their business growing. So we understand the commercials, and in line with that we try to come up with tax advice. If tax advice is only if you make a restructuring only for tax purposes, it's simply not going to work under the GAR of the General Anti-Avoidance Rule under Article 63. It's not going to work.
Is trying to avoid amortization a good commercial reason?
Absolutely not.
Okay, thank you.
Hi, good afternoon. This is Amir here from Tisco International, and we are into trading business. So just wanted to elaborate previous 2 points which came from the other table, and then my colleague had also addressed. It was about the designated free zone. So basically, mainly, I mean, like our nature of business is trading, and it's not that we trade in UAE. We have clients, suppliers, all are like, abroad. So we buy from third port, we ship to third port. So there is nothing, we're doing physically, goods are entering in UAE. So I don't know how it will work if it comes to the level of practicality. How we'll be able to get those goods here and then ship it from here. So practically it won't be possible. So I can see that this nature of business won't be qualifying anywhere. And being a trader, we don't work with high margins or something like that. So it will ultimately affect us somewhere in the, the cost will increase and all. This is something which I'm thinking. For the federal law, it's fine. They had made this all regulations. But when it comes to this part, I don't think so. It will be that easy for us to keep on doing business. So what you suggest, there has to be a free zone who allows this type of activities, and they are being included in the qualifying person. Because when I see as a trader, I think it will be a bit difficult for us And in the UAE, Dubai, most of the people are traders. Locally, we buy a few things, but most of them are like from, overseas. So this is one of my concern.
Yeah.
I think you have to remember, right, that you're being taxed on profits. You're not being taxed on income, right? So that's important. If you're working on smaller margins, then your profit, of course, is much smaller, and it's a percentage of that profit that then gets given. So it should not cause you to go out of business. I mean, if that's the concern, right? That shouldn't be the case. But as we see your point, that is a risk. But that is what tax is about. Tax is about taking from
Okay,
the
and
shareholders
above all, I
and
think
giving to the government. I mean, that's
fine. That's fine.
ultimately what
We are happy that all these regulations are coming in UAE. We're happy to work, paying tax and everything. But again, as a trader, again, we have some time limits when we have to export. The supplier is in hurry. He needs goods. So again, getting those goods here and then exporting. So it will be kind of even after wanting to do few things, we won't be able to have that freedom or, flexibility of doing things. So it will, I think, impact. Somewhere we'll get a bit freezed doing business. This is what I think.
I personally made peace with the fact that we have to pay taxes, and the sooner we make peace with the fact that we have to pay taxes, we'll sleep a lot better as well. I think
that's true. That's true.
And what I want to add to that is, even if you're subject to 9%, if you look around in the GCC, you only have Bahrain remaining at 0%, but that's also going to change. Is my personal expectation, not official EY statement. UAE is still super competitive with the 9%. So what UAE is doing is just leveling up to what the other countries around us have already been done. So it's still competitively advantaged potentially, right?
There's no other way.
Maybe let me explain it. It's in a kind of wider context. I think initially the FTA wanted business like that to be subject to 0%, but when the law came out, it was different. Part of that reason is that the other countries, the other jurisdictions, would see that kind of relief as being anti-competitive to them, right? And so from their perspective, they want to make sure that if you do have a free zone, it has to be a free zone that meets what you might call the litmus test of why do you have a free zone. So free zones essentially, for legacy reasons, were meant to be places through which you imported goods and then you sold goods, right? And free zones were established for customs purposes. So you don't have to pay any customs duty. They come in and they go out. If you're a trader and the goods are not coming in or going out, the question would be, so why didn't you stay in the mainland? Right? You could easily do it in the mainland. So by conducting your trading activity in the free zone, you are unduly taking advantage without actually being a free zone, right? They always ask you, why aren't you in the mainland to do that business, right?
No, we are in free zone, but we are traders. We are not in mainland.
So the real free zone companies who use free zones, when they say real, right, are the entities that are bringing those goods in and then taking them out for customs purposes, right? And because that activity is encouraged for free zones, it's like bonded warehouses, customs warehouses, then you get that relief of no tax. But if you're not doing that, the question would always be, just by locating in the free zone, you're getting 0%, right? So that's the reason. I'm not saying it's wrong, but that's the philosophy behind it.
Right.
Got it. And
good afternoon.
Sorry, there's a question here. That'll be the last question. I'm afraid if there is any further questions that you want to ask, I'm sure some of the panelists might stay behind for lunch. If not, you have their details. You can reach out to them or myself for any further advice or guidance that you require. But we'll take the last question.
The 375, is it profit or is it
profit?
375K limit, is that on profit, or on revenue? That's on profits, right? So finally, I've been asked that we have channel partners that would like to come up on stage and introduce themselves. If you can please make your way up on stage. Okay. So thank you, everyone. Thanks for joining the Maidan Free Zone Tax Seminar. Really appreciate your time. As I said, some of us are available if you've got further questions, and you will have our details. You'll have the presentations later today. But wish you all the best with the tax challenges that lie ahead. I'm sure it's going to be exciting or nerve-wracking at the same time. And yeah, don't forget the QR code. All right, thank you, everyone.
Thank you.